One of my favorite retirement tax strategies. Pablo wants to pipe in. Come here, big boy. Pablo's getting a little bit chunky, by the way. There he is. My name is Pablo. I live on the second floor. I love this dog. He goes, oh, hi. Oh, that doesn't look good, Pablo. All right, so lately I've been dealing with folks that are they're considering doing Roth conversions. Like, I don't think you should do that instead. I don't think you should do that. I think what you should do instead is basically live off your IRA, your 401k/IRA, live off that. Just keep it under, if they qualify for Obamacare surplus subsidies, by all means do that. But at the end of the day, live off your IRA, and then have your taxable account in like VTI or something like that. Just have that puppy grow and grow and grow. That's what I'm telling people lately. Because I get the Roth conversions thing is great, but if we need money, remember the point isn't that we want to move the money from our pre-tax to our post-tax. The point is that we want to move our money from our pre-tax and get rid of the pre-tax. That's the point. It doesn't. The ending result of it being a Roth isn't the end game. The ending result is to get the pre-tax reduced, so you can avoid the widow's tax trap, to avoid tax on Social Security, the whole thing. But I tell you, man, just check this out. So talking to this guy today, he's 56. He's thinking he might hang it up in the next few. He might be, canned, might get laid off, whatever. But basically got 3 to 4 years of work. And I'm just saying, man, just build your VTI, build your VTI, build your VTI. And I'm going to show you how this works. Oh, it's such a fantastic strategy. I was talking to this couple up in Virginia, and they're doing fine. They're never going to get subs. They don't need Obamacare stuff, like federal employee retirees and whatnot. But I'm still the same thing. I'm like, oh, build your VTI, build your VTI, build your VTI. What I was telling her is move your money that's in the C and S fund and their TSP to the G. Well, the G fund's still not quite available, so it's the L fund. The life cycle fund is just like the G fund, except it's only 71% G fund, but it's still pretty doggone close. And then move what they had in a bank account, a brokerage account, into VTI. So live off the G fund, again the L fund, and live off, and then let the VTI grow. So check this out. Oh, I love it. All right, so here's a strategy. I just want to show. We're going to go to dashboard. We got Becky and John sample. All right, I don't remember how old they are, 50, 60, something like that. Let's go to profile. So they got $1 million in VTI. Let me say Roth. $1 million in VTI. Yeah, right there. 1.16 million. Frankly, it doesn't matter. I'm just using this to show you the power of this strategy. $500,000 cost basis. All right, so that's what they got. $1 million in VTI, $500,000 cost basis. That means they have $600,000 of unrealized gains. All right, they're going to need, how much we need? $6,000 a year. What about healthcare? That's all inclusive. All right, they got income of Social Security. Becky will take her Social Security at 70 based on her income of $100,000. John will take his Social Security at, what do I say here, at 67 based on his income of $50,000. We're just going to let the software calculate it for us. All right, so check this out. You ready? All right, so they need $6,000 a year of income. All right, $6,000 a month. That's $72,000. Let's go to tax. Ooh, nada. Look at that. Look at that. Nothing. No tax. None. Now they're starting to pay a couple $100. So we go to 1040. Look at that. Remember, they're living on $75,000 a year, $72,000 a year. Qualified dividends, long-term capital gains right there. All right, so let's look at line Schedule D. Is going to be your capital gains. You're fanning out there. 45,000 long-term capital gain, right? You with me? 25,000 qualified dividends. $70,000 is their income. They're not paying any taxes because it's all still in the 12% tax bracket. Oh, that doesn't make you happy. Nothing does, man. Oh, I love the tax code. All right, so let's. Let's go to Social Security when they're on. I think we'll just say 2030. Yeah, here's their Social Security. So this is just with old John here. They got $27,000 of qualified dividends, $35,000 long-term capital gain, $28,000 of Social Security. And so what's that? We'll say 30, 30, and 30. So $90,000 of income. Their taxable income is $59,000, but because all that taxable income is long-term capital gain, qualified dividends, and they're still in the 12% tax bracket, it's tax-free. Oh, I love it. I love it. I love it. I love it. It just makes me so happy inside. They live in Georgia. No state income taxes in Georgia. Now, what's her name? Becky. We got Becky on Social Security. Check this out. $100,000 of Social Security benefits, $50,000 of qualified dividends. They don't even need any long-term capital gains. They're just reinvest it. Their total taxes at that point are $2,000. Why is their total taxes $2,000? Because they got $50,000 of qualified dividends, and their standard deduction, they're basically a little bit higher than the 12% tax bracket at this point. But still $2,000 of taxes on $150,000 of income. Jeez, man. Oh, that's not a thing of beauty. I don't know what it is, my friends. All right, so let's go to let's change out their we're gonna go to goals. We'll say they need, I don't know, $100,000 a year income. All right, let's check this out. We're gonna go to taxes. Let's see what we got first and foremost. Oh my lands, look at that. Now this is the widow's tax trap right there, but look at that. Such a thing of beauty. IRC, I love you. The IRC is the Internal Revenue Code. Let's go to cash flows. Oh my goodness. Look at, we got, they're pulling $100,000 of their portfolio, all long-term capital gain, no taxes due. I mean, look, man, that is just a freaking thing of beauty. Oh, 2022. $156,000 of long-term capital gain, $25,000 of qualified dividends. They're getting some return to principal as well. $100,000, no taxes. The taxable income is $55,000, no flipping taxes. What's it? I'm not sure what the difference here. I think I got one is the one we got retirement monthly expenses $2,000. Current monthly expenses $8,300. So this is what we're looking at. Just the current plan is what we're looking at. So don't get caught up in that because it doesn't matter. We're looking at this one right here. All right, let's change this to profile. There we go to goals. Let's make that up. Let's say 10,000. Let's see. We want to make it 13. Let's say 12,000 a month. And I don't even. It's not going to work. But let's just see what we got here. We're going to go to tax. Should be a little bit more tax, I think, on the front end because they're above. Yeah, a little bit. Look at that. Let's see what we got. Maybe not though. Let's go to 10. Let's go to 1040. Yeah, 81,000 long-term capital gain. They're still getting a return of principal too. You got $24,000 of qualified dividends, 81,000 long-term capital gain. So you add those two up there, it's $106,000 and no taxes. Why? Only $80,000 of taxable income. So they're still in the 12% tax bracket. Let's change that. Let's just make that one just a tad higher, actually. Goal, we'll say 15,000. I just want to do, again, I don't care the success rate. I just want to show you. So now we have $180,000 of income we need. Yeah, look at that. $180,000 of income, and they're only going to pay freaking, they need $180,000. They're getting $25,000 long-term capital gain, $103,000 from $25,000 from a dividend, $103,000 from was that long-term capital gain? Let's just double check. Yeah, $103,000 long-term capital gain. It's such a freaking thing of beauty, man. And they're paying $3,000 in taxes because they're just above the 12% tax bracket. They're just into the 22% tax bracket. $3,000, $180,000 of income. Oh, a thing of beauty. A thing of beauty. Build up that freaking non-qualified account. I'm telling you, man. It's all right. Love to hear your thoughts. We'll see ya.